Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
So before we do this, I guess it's important to understand what interest deductibility is and what are the types of interest that are deductible. So interest deductibility refers to the ability to deduct the interest paid on loans used for income-producing properties. In this case, we're going to talk about, but also relevant to other assets such as shares, and reducing your taxable income. So this can lead to substantial tax savings, and is really a crucial aspect in understanding and making sure you utilise for your property investment journey. The key factors that determine whether interest is deductible or not comes down to the purpose for which the funds are used for. So if the funds are used for income-producing purposes, such as purchasing an investment property, then generally the interest is deductible. However, if the funds are used for personal purposes, then the interest is not deductible. So this distinction is really critical to ensure that you claim the correct deduction and maximise your tax savings. So we'll run through a couple of different types of interest. Hopefully, we should get a hold of that pretty quickly. So we've got our mortgage interest. So most common type is a mortgage. So you go out and get a loan on a property, or you refinance a property. If you're using that for a rental property, then the interest on the loan is deductible because it's used for an income-producing purpose. We also have construction loan interest. So if you have a construction loan for a property that you plan to rent out, you can claim the interest on that loan as a tax deduction, even though the property is not yet producing income. So the interest on the construction loan can generally be deducted during the construction period as it's actively taking place. Typically about 24 months. Hopefully it's not going to take any longer for that to happen. But definitely keep accurate records of all those interest payments relating to the construction. Good morning, everyone. Morning, Rosie. Morning, Courtney. Good to see you on. Okay, and then we have our non-deductible interest. So equally important to understand what interest is not deductible. So any interest on loans used for personal purposes. So this might be personal loans, so things used for buying a vehicle, funding a holiday, paying off credit card debt. So we can't claim any of these. Um, and then also home loans for your main residence. So if it's your main residence, you're not earning any income from it, then we can't claim any interest, and the interest isn't deductible. So I guess a very quick example. Let's consider concept a bit further. So we've got a $500,000 loan to purchase a rental property. Interest paid on the loan is deductible because the funds are used for income producing purposes. Now let's imagine that you use 50 grand of that to maybe go on a holiday, buy a new car. So we've got interest on 50,000 that's not deductible because it's used for personal purposes and not for an investment or income producing purposes. So this highlights an important scenario, as once a loan's tainted by personal use, it will always be tainted. So you can't change the percentage of that loan that's deductible versus non-deductible. So in that example, we've got 90% of the loan interest will be deductible because it relates to the rental property, but the other 10% we can't claim, and there's no way to alter that in the future. We're kind of stuck with that. So really, really important that you separate it and have it clear at the start for ensuring that you're maximising the deductible interest. And then I guess now I hope this never happens to you, but I've had a few clients where they've sold property for less than the mortgage amount. If you do find yourself in this situation, usually it's been sort of in the mining towns where they've had a boom and a big bust. As a bit of a consolation prize, you can continue to claim the interest on this loan, albeit with a few caveats. All the proceeds of the sale should go to paying down as much of the loan as possible. I think most of the banks are going to make you to do this anyway. And you need to appear to repay the loan from other assets other than from the family home. And also so you don't refinance the loan on extended terms. So you must be doing all you can possible to eliminate the loan. All right, so we know what interest we can claim. So the question now becomes, how do we structure the loans right from the start? So by setting up the loans correctly from the beginning, we can make sure that all eligible deductions are available. We're not avoiding complications further down the line. So there's a few key aspects that we'll run through on that. And the first and foremost is really, as we sort of spoke about before, is separating the investment and personal. So this is really crucial. It makes clear identification of what loans are deductible and what are not. It really simplifies record keeping, not just for you, but also for us as the accountants as well. And just makes it more straightforward on claiming the interest on those loans. So the ownership structure and tax planning, that also comes into it as well. So the deduction of the interest payment actually goes to the name the person whose name is on the title, not necessarily who's on the loan documents. So therefore, it's important to ensure that the ownership structure aligns with your tax planning. So for example, you might have spouses, they might own investment property jointly. The interest deduction should be split accordingly between their ownership percentages. So that's making sure that the names on the titles are correct to align with the deductions. Then we have interest-only loans. So I guess this is sort of more about a investing strategy as opposed to tax planning, but it will allow you to pay off the interest for a specified period, so typically 5 to 10 years, where you're not paying any of the principal, it's only the interest repayments. And there might be a couple of reasons that you do this for. So it might be that you are using this period just to, I guess, improve cash flow, or you might be able to use the additional funds that you've got to pay off your non-deductible debt faster. And then also, I guess, it's part of your broader strategy on, I guess, how you're using your cash. It may be that you're anticipating quick capital growth, so you just want to minimize the outlay and get that through on that side of things. But I guess just be aware that once the interest-only period ends, the loan will revert to principal and interest, which will be a higher repayment. So plan for this, avoid the financial strain. And then lastly, I guess the other thing to consider with the interest only is the possibility of paying interest in advance. So this flexibility can be really great when it comes to a particular year where you've got an increase in taxable income. So you might have a property that's sold, you've got a capital gain, and you might want to repay the next 12 months of interest on another property just to reduce that taxable income for the year. Now, we spoke earlier about claiming interest on construction loans as well. So a couple of things there just to point out that you need to really link the loan to the construction. So having a separate loan for the construction portion will make it easier. Now, the deduction period, so we quickly ran through that. So when the construction is actively taking place, and really make sure that you've got all your loan documents and records to show that that's what it's for. I mean, most of the time you'll have the progress payment, so it'll be fairly obvious, but just really make sure you've got your paperwork in order. All right. Now we're going to have a look at debt recycling. So this is a pretty powerful strategy that allows investors to convert non-deductible debt, such as your home loan for your PPR, into deductible debt. So this process can significantly enhance your tax efficiency while also improving your overall position. So if we have a look at how that works, I mean, the concept is you're effectively pulling equity out of a non-income producing asset into an income producing asset. So by converting this equity into debt, you're making the interest deductible. So I guess the steps to implement this is really just to assess the equity that you've got available in your PPR, getting a valuation, sort of understanding where you sit, and then having the discussion with your broker. So ensuring you've got the sufficient equity in there so your LVRs are still going to be maintained at the right level for the lender. Make sure you seek advice with your advisors just to understand the best way to structure your loans for the investment. There's a few complexities in that, particularly about cross-collateralization. So I guess that's something that we want to somewhat avoid. And then if we do have to do it, I guess then having a plan in place to undo that later on with refinancing. And I mean, regularly review and adjust too. I mean, it's super easy now to refinance, so there's no need to put up with a higher interest rate. And really make sure that you've got all of your documents and everything in place as well. So something that's important is borrowing costs. So every time you take out a loan, they always hit you with all these fees. So that's something that we can claim. So really important that you keep a track of your loan documentation, as normally they're hidden within there. So if we have a bit of an example to illustrate the debt recyclings, suppose you've got $200,000 in equity in your home. You want to take out an investment loan using this equity as collateral. So the interest on that investment loan is tax deductible, reducing your taxable income. So you're getting the deduction benefit of that. And then you're using the excess to pay off your PPR. Perfect. All right. So then this probably brings us to the last point, but a really important one is redraw over offset accounts. So really key difference here, and it's crucial to understand for optimizing the interest deductibility. So both options can be used effectively, but it's really needing to understand the key differences and how to use them. So a redraw account or redraw facility allows you to withdraw extra repayments that you've made on the loan. So while this can be useful for accessing funds, it can complicate interest deductibility if the redraw is for personal expenses. So the key thing to note for redraw is that each time you redraw, the ATO treat this as new borrowings. So this is the key. So important things to consider are, I guess, a redraw facility gives you access to extra repayments that you've made on the loan. So this can be helpful, I guess, in cases of emergencies where you really need to get some cash fast. But the other thing is just to understand the complications with deductibility. So if you redraw it for personal expenses, then you can potentially have one of these mixed portion loans where we've got some for personal use and some for investment, and it can taint the loan then. So really understanding that and making sure that you're not accidentally drawing out extra repayments as a redraw for something personal is really key. And then we have our offset account. So I guess it's basically a transaction account linked to your mortgage. It's not actually part of the loan, but the bank use that amount that sits in there to reduce the amount of interest you're charged by. So I guess importantly, savings are achieved through the offset account. And I guess the key is then to use that against the non-deductible debt. And I guess the other thing that I guess we see often is that people draw out of their offset account to pay for an investment, or maybe like the deposit for an investment, thinking that now because the interest payments have gone up, they can now claim those extra interest repayments as a deduction. So not the case. The offset account is really used as a almost as like a savings account. So I guess the key there is to really make sure you're offsetting your non-deductible debt. I mean, there will be times where, depending if you've got a really, really high interest rate, that maybe the figures add up to maybe it's best off in the really high interest deductible, but that will be pretty uncommon for most people. And it's really, I guess, just using it strategically to offset the balances. And if you've got a PPR that doesn't have any non-deductible debt, then obviously you want an offset account to put all of your income, wages, everything into, that's going to offset probably the most highest interest loan that you've got. Perfect. All right, guys. So we've gone through a couple of different strategies on how to optimize interest deductibility. I guess the key thing is to really understand what's deductible and getting it right from the start. So that's the best thing. So always chat to your advisor, broker, and accountant beforehand. Keep excellent records. As always, ATO, the onus is on you, and use those offset accounts efficiently. So thanks, everyone. I hope you guys have a great day, and we'll chat to you soon. See ya.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.